positive numbers for most of the session. It was the fixed income, the interest rate side, that seemed to idle a bit. Consider, we are 2 basis points above a low yield close for 10-year notes that goes all the way back to September of 2017. Current low is 207. We're hovering right around 209. Reporting from the CME Group trading floor, I'm Rick Santelli with CNBC Business News, Chicago.
Rick, you're the man. Right, let's bring in Jay Jacobs now, Senior Vice President and Head of Research and Strategy at Global X Funds. He joins us live from New York. Jay, thanks for your time today. What is the risk this week that the Fed disappoints the markets?
Well, I think the markets have very much decided that the Fed is going to be aggressively cutting rates throughout the rest of the year. I mean, basically the market is betting 3 rate cuts through the end of December, which is very aggressive in a non-recessionary environment. If the Fed indicates anything that is less aggressive than that, I think we could see serious market volatility as people try to digest that information.
Right, but typically when we see the markets at or nearing their peak levels in any cycle, we always associate that with perhaps an indication for the Fed to hike, and that's what happened between 2004 to 2006. This cycle is different, I know, but it's interesting to see how confident the markets are, whether it's about underlying economic data, whether it's about, earnings, given the strong gains we've experienced year to date, and even right now, we're talking about record high levels once again for the benchmark indices.
Yeah, this is kind of a soft record high. I don't think there's elation in this market. I don't think there's really kind of any cheering going on Wall Street right now. I think it's very much a Fed-driven market, and when the Fed continues to be very supportive of low interest rates, keeping a high balance sheet, and having this put that they're always going to be supportive of the markets if volatility flares up, gives people a lot of confidence to be in equities, and conversely also keeps people out of fixed income, because if you're a retiree and you're looking for income for your portfolio, there's just no yield to be had. So we're in a market that's just very supportive of stock prices, but doesn't necessarily mean that there's elation in the stock market right now.
Right, but the TIC data also reflects that there's a fair amount of money coming in into the securities market, into shorter tenure as well as longer-term bonds, and I want to get your perspective in on that. Do you think that this bond buying spree that we are seeing, which is pushing down yields, is largely a de-risking strategy for portfolios?
I think it could be, but more in the global sense of, if people are looking for a safe haven, the U.S. continues to be really kind of the safest perceived area in the world, and on top of that you're getting 2% yield on a 10-year treasury, so that's much more attractive than anything in Europe, anything in Japan, and in many cases even in emerging markets. So I think there's depression in bond yields because people are looking for somewhere to put their money, and the U.S. just kind of becomes that default area.
Jay, so if the Fed does not give what the markets are hoping for, and that is anything in the region of 2 to 3 rate cuts, if the narrative from the Fed this week is not consistent with those expectations, then the market throws its toys out of the pram. What does that look like in terms of a de-rating?
I think we could see a huge spike in volatility. I think we could see a big cycle out of growth stocks into value stocks, which have underperformed for almost 10 years now. I think you could see a lot of money moving into defensives, so healthcare, which has really lagged over the last couple of months and throughout the year, could suddenly see a big spike. But I think it would cause a full market rotation of really people looking at the current world order of the Fed being supportive of this market starting to flip on its head, and people looking at kind of a completely different script going forward.
Gotcha. And if I can throw in another variable, and that is G20 and post-G20 deal or no deal, is that the inflection point that will determine whether the economic data really takes a turn for the worse because of the uncertainty factor? And does that force the Fed to come off the fence?
I think one of the reasons why why no one's predicting the Fed is going to cut rates now at this June meeting is because they do want to see what happens at the G20. I don't believe people are betting on any sort of deal, and it's looking less and less likely, but to buy a little bit more time for this global event to pass and see if anything happens, I think is kind of worth the market being a little bit patient. But assuming there's no deal, July meeting happens, that's where we expect the cut to happen. But you know, the G20 will be important, but I don't think people are too bullish on any deal being achieved there.
Right, but Jay, how would you build a case for a July rate cut versus a September rate cut currently?
Well, I think the case is that, you know, we're starting to see slowing global economic growth, and that's really starting to show up in a lot of the global manufacturing numbers. A lot of PMI numbers are starting to look more negative. This trade war is getting more serious by the day. People really have to reorient their supply chain. So the case is being made there on the global level. I think if you look at the United States, there are some attractive areas like pipelines and real estate, which are very domestic focused. They benefit from rate cuts. But when you look outside the United States, or you look at the technology sector, which is very internationally focused, you do start to see those concerns start to flare up.
Yeah, that seems to be the case. Jay, thanks very much for taking out the time to be with us this morning. Really appreciate your thoughts and your insights. Coming up, releasing the floodgates for investments, the London-Shanghai Stock Connect now officially open for business, but will it attract investor interest? The details on that story coming up next.
The Bond Report is brought to you by PIMCO.
Established in Hong Kong in 1985 and currently based in Guangdong, China, Yueshio Group has undergone over 30 years of reform and development. Its asset portfolio ranks amongst the top state-owned enterprise groups in Guangzhou. Yueshio Group established a 3+X modern system incorporating major industries, including finance, real estate, and transportation, infrastructure, traditional industries like papermaking, as well as strategic emerging industries. In 2014, the group acquired Chongqing Bank as part of its effort to build itself into an international financial holding group. In 2018, Yueshio Group's total assets reached RMB 600 billion, with an annual revenue of RMB 48.3 billion. Yueshio Group will create greater value for the world. Beyond excellence, Yueshio Group.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, Morgan Brennan, John Ford. Squawk Alley on CNBC.
As climate target deadlines loom closer, the future of tech, it seems, is green.
Digitalization and decarbonization are walking the path together.
We check out zero-emission transport solutions.
There's so much more space in the third dimension than what we have on the ground.
And discuss the obstacles in the road.
Infrastructure is a big challenge, and that's where the politicians come in.
The Edge at the first ever Green Tech Festival, only on CNBC.
During Melania Trump's UN speech today, she spoke out against bullying, and then her husband took the stage to give the rebuttal.
Late Night with Seth Meyers, this weekend.
After 4 years of talks, London and Shanghai listed firms are now able to raise funds on each other's stock markets with the launch of a new Stock Connect. UK Finance Minister Philip Hammond calling the programme a step towards deeper financial relationships between the two countries.
This is a deep piece of infrastructure change. It's very important to the growing connectivity of financial markets, and it recognises the reality that over the next decades, China is going to become a vitally important investment market.
Huatai Securities, one of China's largest brokerages, becoming the first company to list global depository receipts in London under the new link. Shares rose as much as 7% from its offer price before closing up nearly 4%. Trading volume, though, was low as market participants acquainted themselves with the product. CBC's Jeff Cutmore caught up with Huatai Securities Chairman and President Zhou Yi and asked about the impact of global uncertainties.
We can see the uncertainty of international markets, but our job is to follow our set strategy and make it into practice. GDR is a great example, as it opens the pathway for us to enter the European market, and as you know, that we also received approval from FINRA to expand our US businesses a few days ago. I joined Huatai 13 years ago, and I saw the growth over years from a small security company into a company with over 100 million RMB of equity capital. We've experienced a lot of uncertainty in the past, and that is how we grow amid all the uncertainties.
Are you concerned at all that the ongoing trade row between China and the United States may slow down your investment program or put it on the back burner?
We acquired AssetMark in 2016, and the company has been growing well in the past few years, as shown in its financial report. We have announced the spin-off IPO for AssetMark in the US, and over the course of years, CFIUS and other relevant regulators in the US have voiced support for AssetMark, as well as our part in this business. We will continue to support the growth of AssetMark, and we hope to launch our US business soon, with approval from regulators. Despite the macro challenges between China and the US, all of these initiatives are executed as planned.
So, I think the first thing to say is that China is saying, hey, we are open for business regardless of these ill winds that are blowing on the trade front. But I think at the end of the day, it really comes down to, in time, whether we are going to really see the flows, whether we are going to see investor participation, and whether it's going to be London-bound or whether it's going to be Shanghai-bound. And I think if it is London-bound, then that will be very helpful in a post-Brexit environment. If it is Shanghai-bound, then from China's point of view, this is good news from a liberalisation point of view, and coming on the back of MSCI inclusion factor being ramped up as well. So more foreign participation deepens liquidity in the Chinese markets and makes it less, arguably, volatile and less retail-driven. So no bad thing, net-net, for both sides.
No bad thing, and I think it's very clear that China is trying to build its bilateral relations in parallel to what's happening with the US-China trade war, and so they want investment and business relations with other countries, especially Europe, where, you know, we see that with the BRI Belt and Road Initiative, and UK, you know,
it's
being...
It's not going to be easy, though. It's not going to be easy, though,
it's
because especially in the Huawei environment, and Germany and other countries within Europe really saying, look, we need to handle this a little bit carefully. We need to be looking at the national security concerns as well. You're quite right. I think the likes of Italy, Greece, at the height of their debt crisis, have really pivoted towards China. I think Western and Central Europe arguably are a little bit more circumspect.
No, so there will be risky points. My only, you know, highlight there is about the kind of depression that is happening in Europe and UK on account of asset prices decelerating. It gives a great opportunity to get bargains in the M&A space, in mergers and acquisitions. So I think for Chinese companies, that's an open space. You know, look at Europe, because things are moving a bit southwards with its market conditions, economic conditions. And I think that may work very well. It's another area to explore from an investment and, like I said, business perspective.
Absolutely correct.
But we'll talk about that as we go along on the show. A lot more to discuss on that issue. However, coming up, foreign flows to U.S. Treasuries are dropping in April. We'll tell you who's been cutting holdings the most when Squawk continues.
I'd like to donate these books.
Thank you very much.
Where do you get that book?
A man donated it.
Yes?
I'm sorry, but I need to retrieve
I believe you're looking for this.
No. Thank you so much.
Return the book.
Oil and Gas 4.0 means rethinking